Thanks for clicking. Canada's borrowing costs are surging upward this week on US debt woes, with yields surging upwards and the 5-year Government of Canada yield breaking 4.3% for the first time since 2007. The yields were following that of US Treasuries, also surging to a 15-year high this week. And, as so often happens, fixed mortgage rates followed, with a 5-year fixed insured mortgage rate, the cheapest of all mortgage rates, inching closer and closer to 6%.
If you don't do something, I gotta question your leadership.
And while threats that the US government will once again shut down is no doubt stoking angst in the market, and the US has been warned by Moody's that another shutdown would hurt its credit rating, there is something else going on, much bigger and much more difficult to control, with much greater consequences for Canada, and that is, according to Goldman Sachs, the growing pile of US debt. Given that, as we've seen before, Canada's borrowing costs are largely related to the US and largely outside of our control, and given that some are predicting that yields could go even higher, and therefore mortgage rates could go even higher, this is definitely concerning news. So what I want to do today is go over US yields, how much it costs the US to borrow, take a look at why that rate is rising, discuss some options available to the US, and then look at the implications for Canada going forward. It is the end of the month, and we are eagerly awaiting September's real estate data to start coming out from the local boards early next week, and we'll obviously have updates out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into Treasury yields. On to Treasury yields. US Treasuries, what the US government uses to borrow money. Yields on US government bonds have been surging rapidly, up 40 basis points this month and up over 130 basis points in the past 6 months. And with yields on US Treasuries increasing, it's going to cost the US more to borrow money. Same here in Canada. As we've talked about so many times on this channel, when yields rise, it costs more for governments to borrow money, and as such, it costs more for you and I to borrow money.
You f***ed me. I did not.
Which begs the question, why are US Treasury yields rising so rapidly? Well, the Fed's recent messaging that it will be staying higher for longer is no doubt putting upward pressure on bond yields. Also at work is the flip side of that messaging, that US inflation will also be staying higher for longer, with some estimates coming in that inflation won't return to target until 2026. And, says George Cole of Goldman Sachs, if inflation is going to remain higher for longer, investors are going to demand a higher return on government debt, as inflation will wipe out the value of any return. And we've talked about this before on this channel. If I lend you money at 5% and you give it back to me in a year, but inflation was 7%, I've actually lost money lending it to you.
That's gotta suck.
So right away, right now, lenders are demanding more of a return from the US government, as the US dollars that they're getting back in return aren't worth as much as they once were. And this concern that inflation is eating away at the real returns on those lending the US money comes as the US is piling on the debt, set to issue another $4.8 trillion in new debt by the end of 2024, as its deficit continues to balloon, and the US grew its debt by $2 trillion in this year alone. In fact, according to the US debt clock, by 2027, the national debt is expected to reach almost $45 trillion, or 150% of GDP. So, by most estimates, over the next few years, over the next 3 or 4 years, the United States is going to be borrowing a lot more money, at a time when those who lend the US money are getting more concerned about their returns. And this is where the heart of the problem comes in, where the US government gets its money. Governments have only 2 sources of money. They can tax or they can borrow. That's it.
I've got an idea.
Yes, they can also print, but we'll get to that. The issuance of all this debt on the part of the US is coming as demand for that debt is plummeting, with China, the second largest holder of US Treasury bonds, reducing its holdings to a 14-year low. In fact, China's holdings of US Treasuries, China's willingness to hold US debt, is down by $80 billion since this point in time a year ago. And on this, I think it's briefly worth noting that bond prices and yields are inversely related. Meaning, if I lend you money for $100 at a 5% interest rate at the end of the year, you owe me $105. However, if I sell that debt to Jen for, say, $95, at the end of the year, you owe Jen $105, but she only paid $95 for that debt. So Jen is yielding 10% versus the 5% that I was yielding. So when China, when Brazil, when Saudi Arabia sell their bonds, sell their US Treasury bonds, they're flooding the market with US debt. And as such, the price for that debt is going to plummet. And as we saw, when bond prices plummet, yields go up. Interest rates go up. And while China getting rid of US Treasury bonds is no doubt at least in part due to the rising geopolitical conflict with the United States, it's also in part due to rising US inflation. That is, the lower purchasing power of US dollars. As billionaire hedge fund manager Bill Ackman just recently noted, you're not being paid enough to enter into a 30-year contract with this government. If you had a borrower set to increase their debt load by 30% and they're just printing new money to pay you back, would you want a 4% return? And with potential lenders, potential buyers of US debt drying up, and tax increases basically off of the table in Washington, with US debt needs growing by the trillion, the only other option is the money printer.
Cause of and solution to.
And how would they print it? Through quantitative easing, where the Federal Reserve buys up US bonds directly from the banks with printed money. After all, if the market doesn't want the bonds at current rates, doesn't want a bond that only yields, say, 4 or 5%, then why can't the Federal Reserve just buy up the bonds themselves? It wouldn't be the first time. The Federal Reserve, as of right now, has already had 3 rounds of quantitative easing where it bought up US Treasuries. The first in 2010 when they bought up $600 to $800 billion worth of US Treasuries. The second in 2012 when they bought up another $800 billion of US government bonds. And then finally, of course, in 2020 when they bought up a little over $3 trillion worth of US Treasuries with printed money. However, the key difference between right now and what we had during the 2010s and in 2020 is that during those periods of quantitative easing, the Fed was fighting disinflation. The Fed was fighting deflation. However, as we see in the news right now, the inflation story is much different, as US inflation is showing signs of accelerating. And as we're seeing in Canada, as we're seeing in the US, creating money out of thin air has consequences.
Oh, it doesn't.
Bears repeating, creating money out of thin air has consequences. And were the US to restart up the money printer, were the US to restart up quantitative easing in an inflationary environment, that could work to further ignite the inflationary fire. Even the IMF, in June of this year, was warning against central banks using quantitative easing going forward, noting that there should be a wariness about restarting QE, especially when inflation remains only modestly below target. So, taken all together, the extent to which US debt is set to rise over the next 3 or 4 years, the appetite for that debt in the market diminishing, at least diminishing at the current rates being paid by the US, combined with political gridlock and the Fed being unable, hopefully, to restart the money printer in an inflationary environment, all points to higher borrowing costs for the US, for Canada, and for you going forward. And, at least for right now, US debt is seen as far more attractive than Canadian debt, far more attractive than debt from you and I, and as such, when you and I go to the market to compete for debt, when we go to the market to try to borrow money, we're competing with the United States. We're competing with the biggest guy on the block, whose borrowing costs are rising, whose borrowing needs and borrowing costs are going through the roof. As such, if lenders are going to charge them more money, that means they're going to charge us more money.
Well, if anybody wants to make a move.
As we've talked about before on this channel, the Bank of Canada only has so much power, only has so much influence within the context of a global economy. And our neighbor to the south, the elephant to the south, its borrowing needs are growing almost exponentially. And as such, if its borrowing needs exceeds the ability or willingness of investors to lend it money or lend it money at current rates, then the US government, then the United States is going to have to pay more money. They're going to have to pay a higher rate of interest in order to service its ballooning debt. And as such, even though Canada does not have that debt, even though you and I don't have that debt, we're going to have to pay more as well. With that said, we will continue to track the Bank of Canada and the Canadian economy's responses to growing pressure south of the border on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.